Hello and welcome to the Deep Dive by Cap STRAT. Let's talk market regimes.
But before that, why don't you tell the viewers where you've been?
I am proud to be a girl dad. Get a couple of weeks off to hang out with my girls at home, watch some WNBA, become a fan.
Write in the comments if that's a good reason to not put out a video for 2 weeks. Let us know.
But we're back and we're talking market regimes. First off, we want to note, we, along with our clients, we're long-term investors, right? That's what the investment framework is for. And our viewers have heard, plenty about the investment framework. But what we've done overlaid on top of that is this market regime framework. So Mike, can you introduce us to this market regime framework, explain what all these different colors mean on this S&P 500 chart?
Since the beginning of 2023, we've had various market regimes. The S&P 500 has been on this path from about 4,000 all the way up to 5,800. The investment framework is trying to predict the direction, up and to the right, hopefully. But our regimes, no landing, immaculate landing, bumpy landing, hard landing, they're the tool, the overlay we use sort of as a vibe check along the way. The market is not thinking up and to the right at all times. At sometimes it's very doom and gloom. At sometimes it's euphoria. And our market regimes show how different areas of financial markets perform along the way.
Yeah. So let's dive into those vibes a little bit further. And I think a good way to explain this, we've added a fourth bear to the Goldilocks and the three bears situation, right? Yeah. So you've got no landing, too hot, inflation too high, economic growth too strong, Fed can't cut. Hard landing too cold, the opposite of that, think recession. Right? Immaculate landing is kind of our version of the just right, but it's even better. It's euphoric. It's perfect.
Yeah, the soup is delicious.
The soup is just incredible. Best soup you've had. And then bumpy landing it's tough. It's heated up a little bit more in the microwave, throw an ice cube in it. Heat it up a little bit more, kind of going back and forth. So what are the things we look at when we're determining which regime we're in and potentially which regime we could be going to?
So we have a list of economic data points and market-based indicators, all of which that are forward-looking. And we develop price targets for each regime. So for example, if expectations for the Fed funds rate only show a couple cuts over the next 12 months, that's very no landing to us at this point in the cycle. If they show something like 8 cuts over the next 3 months, that's very hard landing at this point in the cycle. So it's a pricing mechanism. We go through, we establish price targets for each of these indicators plus a handful of others. And we say, how close are we to pricing in firmly one of these regimes from a macro standpoint? Is the market sort of all in on this bumpy landing?
Yep.
And that has implications for, as we said, financial asset prices. But the other thing we look at is how saturated is the regime. If the market stays in one regime for too long, what ends up happening is the bumpy landing gets fully priced in to assets. And traders don't want to sit in trades that aren't going to make money. So they're looking for a catalyst to shift into another regime. They're thinking, the juice is out of the squeeze here. I'm not going to make any money. Everybody has the same trade on. We're all on one side of the boat. Give me a data shock.
Yep.
Some key economic data point that's going to shift us from bumpy landing to immaculate landing, because this is a whole new opportunity set. Plenty of new opportunities to make money. So we use it a little bit as a front-running tool, a risk management tool. If the market is fully baked in bumpy landing, we look at our economic data points, the key economic data points, the trifecta that usually will shift you out of one regime and into another, are inflation, the labor market, and Fed meetings. Those are the ones.
Yep.
So we think, what's going to happen with those key data points? Is that going to move us into a different regime? It influences tactical positioning, risk management. It's a great overlay to our framework. Yeah.
And there's a special fourth potential data shock that we only get once every 4 years that we'll hit on in just a minute here. But first, why are these different regimes so important? Well, it's because the performance of various areas of the market is going to be significantly different depending on the regime we're in.
Yep. Starting off with no landing, that's historically the worst regime. So these are different asset, each of these bars is a different asset class, These are their average return across each of these regimes since 2022. And the numbers are annualized because these regimes, they don't last for a full year. So we annualize them all, so they're apples to apples. And you can see in the no landing, cash is king, cash and commodities. Everything else is ugly. Bond yields are rising because the economy is too hot. The Fed can't cut. They might even have to hike. Stocks don't like it either. This is very 2022. Horrible environment for a diversified portfolio. If there's any risk that we think the market's going to shift into a no landing, we take that very seriously. We risk manage appropriately. On the flip side of that, you have the immaculate landing. This is great.
Yep.
Buy the riskiest.
Broke the axis for small caps.
Exactly. And when we've talked so much this summer about the great rotation, even though we didn't think an immaculate landing economic outcome is the most likely outcome here, if there's any chance the market's going to move into an immaculate landing, which once again is like euphoria, the growth data is going to be perfect and inflation is coming down, it's immaculate, then the biggest opportunities throughout the summer were in the immaculate landing winners, like small caps. So that's where you saw us reposition portfolios to try to take advantage of that. And then of course you look at bumpy landing, it's sort of, not quite, as you said, it's in the microwave, you add an ice cube, but it's generally a constructive environment for a diversified portfolio. Most asset classes make money. It's not a horrible place to be. It's sort of steady eddy. And then of course, the hard landing, that's classic recessionary environment. You want to own bonds, you want to own high quality, long duration bonds. They're a great recession hedge, or cash, stocks, commodities, anything tied to economic growth that has any cyclicality in it is going to sell off. This doesn't mean a recession has to happen. It hasn't happened. But the market can behave as if a recession is going to happen or there's a risk. And that's how markets react in the near term.
Yeah. And as we saw earlier, market currently pricing in a bumpy landing, right? But the shock that could be coming is the 2024 U.S. elections, right? And we should note off the top, polling, as we sit here today, still within the margin of error, particularly within the swing states that are likely to determine the presidential election. But starting to see a different story in betting markets and in overall financial markets. So here, looking at betting markets, what we have on the y-axis is the probability of Republican control, and if we just kind of power rank these potential outcomes, we've talked for some time about how the Senate is likely to be controlled by the Republicans. But the presidential and the House races starting to turn pretty significantly.
Yeah. Betting odds believe three things in order of confidence. One, the Senate is going to flip Republican. Two, Donald Trump is going to outperform polling in swing states by a margin similar to the margins that he outperformed in 2016 and 2020. If that happens, he will win the presidency. And then finally, that the House will go with the presidency. So each of those lines you see dipping below the 50 mark, that means Republicans are favored in terms of betting odds. Now, that is totally different from about a month ago. And also, if we spoke a month ago, not only did we say it was anyone's race, but thankfully, we said markets are not placing their chips on any one scenario. Betting odds are placing their chips on a Republican sweep, and now markets are starting to put chips down as well. So we see that here, because betting odds are historically unreliable and very volatile, the market is supposed to be the smart money. So we've constructed a portfolio of Republican sweep type trades and track how is that doing, the red line, versus the S&P 500, the dark blue line, to see is the market betting on one outcome. And you can see over time these various events that have happened. It's certainly been volatile, but this comeback since early October, the Republican sweep portfolio has rallied and is now outperforming the S&P 500 year to date. It's up almost 36% thus far in October. Markets are really moving in a big way and putting their chips on a Republican sweep type outcome.
Yep. And if we do get that Republican sweep type outcome, we're talking about things like reduced immigration, tariffs, of course, and some pretty significant additional fiscal spending. So what does that look like from a regime standpoint? Where does that move us to?
Right. Because historically you say Republican sweep, Trump presidency, that should be a good thing for markets. Markets love tax cuts.
Yep.
We also talked about how Republican sweep could be a somewhat benign election outcome. But the key here is we think that basically you're looking at an unfunded fiscal expansion of anywhere from $1 to $1.5 trillion, which in most instances is great. That level of stimulus, great thing for the stock market. But if it comes at the wrong time, that could be nasty.
Yep.
Right now, we think that outcome, if it were to transpire, would shift the market into a no landing. Yeah. It would push up bond yields. Equities would probably struggle. Small caps might sell off. Cash would be king in that type of an environment. So, it's kind of like the last thing an economy that's near capacity. We think the US economy is operating near full capacity with a tight labor market that's trying to defeat the last mile of inflation. The last thing it needs is an additional $1 to $1.5 trillion worth of stimulus. In 2016, throw that on the market, it's totally fine.
Yep.
The economy has capacity, inflation is nowhere to be found, the Fed already has rates at 0, let's go. Very different starting point. So yeah, we think that outcome could flip us into a no landing, which could be a bit unfavorable for markets.
Yeah, and you contrast that with the more benign outcomes we've talked about in the past, which is either Congress, a separate party than the presidency, or a split Congress with the presidency, and that would likely keep us in the bumpy landing regime.
Yeah, and we're not being partisan here. If this was showing Democrats sweep, we'd have the same outlook.
Right.
They are also, if they were to sweep, would enact an unfunded fiscal expansion of a similar magnitude that would also probably flip markets into a no landing, which would be bad this time. We just can't have deficits at the level we do, with the labor shortages we do, and enact stimulus like we're in a recession. Yeah. It just doesn't work.
Yeah. In Democrat sweep, tough to really talk about or give credence to, just given those Senate probabilities and the math in the Senate elections. So, well, that will do it for this edition of the Deep Dive. If you have any questions or comments, please feel free to reach out.